There we go. Oh,
Awesome.
thank you. That would have been a blunder. That would have been a
Yeah.
blunder. Okay. So, so now ADP, that's two. There's a forecast that it's going to come out much less, 110 compared to last month, 143. Right. So we're expecting a contraction of some sort as well there. So I think that alone should, or does influence our bias one way or the other, right? So we're expecting to continue holding on to our buys or our bias anyway on gold bulls and GBP Euro USD bulls as well, right? So let's see if indeed it comes out that way tomorrow, then definitely we are in the right direction already. Okay. So if you can find your entry, it's not always that you have to wait for the data. If you can find the technical picture matching your bias or what you believe will likely happen in the market, if you can find a correlation leading up to the data, then you may as well enter the trade. And if the data does indeed come out as anticipated, you're already in the trade. You're not
Mm.
rushing to find entry. Does that make sense?
Yeah.
Okay, so let's see,
Yep.
like for example, statement coming to this point, you should have, you don't want the market to hold you hostage and wait the whole night, right? So your pending orders should be there, your stop loss already should be set, right? Or cool off, come into the zone, and then enter you into the trade. Now, come tomorrow when the data comes out in your favor, you're already in the trade. You're already in it. Okay, and that goes for any pair that you may be looking at. Now, it's not the only thing that we're getting tomorrow, which makes it a little interesting. We get advanced GDP quarter on quarter, which I've been waiting for some time. This is what may likely bring about some volatility, right? This is likely going to give us some volatility. Price action will dictate where we are going, right? What do I mean? Advanced GDP, quarter on quarter, it's extremely important. Let's see that number, 3% in the previous month. We're expecting it to remain, stable at 3%. Um, the previous two quarters, Q1, Q2, were quite good, right? GDP has been, relatively good. And Q3, there's an expectation that it will stay the same. So this quarter-on-quarter data is basically from Q3. We're getting because we're on Q4 now. So we usually get it, yes, in the first month of of a new quarter. Let me put it that way. So this is basically data for June, July, no, no, I lie. July, August, September, right? That's Q3, July, August, September. So that's the data that we're getting. I guess while we are, okay, no, I'll come back to GDP anyway. And for us to look at this just slightly deeper and why it's important, because this is numbers that I look at as well. Um,
Okay.
yeah, so we'll look into that. I just want us to just look at the labor data, right? So let's pretend for a moment there's no GDP numbers coming out. If you look at the previous uh, NFP week, you won't find a GDP quarter on quarter. So yeah, which would make it arguably much easier for you to engage the labor data because there's no other much significant data coming out. It's just labor data. So this time around, it's just going to be a little tricky, right? But we'll come back to it. That's Thursday. Sorry, that's Wednesday. Then Thursday, what do we get? We get, oh yes, core PCE, that's inflation
Cool.
data, right? There's an expectation that is going to come out ever so slightly higher, 0.1 to 0.3. Let's see if it does come out a little higher. That would definitely push gold to the upside. That is inflation data, right? And it's one of the Fed's favorite. So hopefully it pushes to the downside instead of to the upside, if anything, right? Employment
Okay.
index.
Sorry,
Sure, go ahead.
apologies to interrupt you.
Yeah.
So you're saying the core CPE, if that data comes out lower than 0.3, it will push gold up and it will push the dollar down.
100%.
Okay.
Yeah. So if
When
gold,
Okay.
when it comes above 0.3,
no, lower,
No,
below.
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 Okay.
Yeah, right. If your inflation numbers print lower, your currency, you know, devalues as well. If it
Gotcha.
prints higher, your currency appreciates in value. So in other words, it becomes bullish, right? This is all in anticipation that then the Fed has to do something about it, right? And that something is likely interest rate hikes or keep interest rates elevated. Okay, so that's why I say we hopefully will see not such a high print on inflation, maybe 0 0.0, 0.1 again. That would keep it flat, right? But if it prints higher
Okay.
as projected, then we may see an uptick on the dollar. And if that's the case, what needs to happen, we have to see gold prices come down. But then, anyway, gold doesn't really take significant dips in the last couple of weeks, months, because of this geopolitical event, the Middle East, right? So that remains elevated. It's really not affected by dollar performance late, anyway. Employment cost index, quarter on quarter, there's an expectation that it will stay consistent at 0.9. Should it stay that way, that's positive for the dollar. If it prints lower, that is negative, right? Um,
Hmm.
and yeah, if it prints negative, well, we're already in that trade, right? We'll be already in those GU buys. So let's see how that plays out. Now, don't forget the context, right? The Fed ideally wants to see, labor come down. They might come out and say they're a little concerned about it. But no, no, I don't think they are that concerned. If anything, for the last 2 years, they've been wanting to see um, employment, costs come down, unemployment rise. They've basically, broadly speaking, wanted to achieve a much cooler um, labor force, which is quite a contrast compared to what we've been reading back in 2019, where that was a concern for them. The labor, the economy, broadly speaking, was cooling down. So this time around, what they've been trying to achieve is just that, to cool down the economy. Now,
Um,
yep.
Sorry, just a question.
Yes, yes.
So with the unemployment cost index, how is it different from the JOLTS job openings? Because doesn't the JOLTS also do what's happening in the labor market?
Yeah, so uh, your jobs opening is, how can I put it? Okay, the difference between jobs opening and your your employment cost index. This is there is the jobs opening is the amount of jobs available, right?
That they created,
Okay.
lost,
Yes,
and so on. So
right.
I think,
Yeah,
mm-hmm,
you're right for the previous month, right? So
mm-hmm,
we will be basically, because we remember we get NFP at the first Friday of a new month. right? So
Yeah,
this data will be coming out
from September.
in, yeah, not quite September, October, right? Because we're getting NFP first Friday of November. So now we're going back and saying, how did October perform in terms of labor? So this data,
Oh, I think
is-
I was confused when I was reading the articles on the feedback that we got from
oh,
today because it says job openings slipped to 7.4 in
mhm.
September.
Oh, am I reading it wrong? Are they looking, is it?
So I figured they're working a month.
No, you could be right. Maybe,
Maybe just go and check it and
yeah,
for
you
the
could be right. Maybe
explanation
it's not
can be
September.
correct.
Maybe you could be, yeah, you could be right. Maybe September, not October. So maybe we're always 1 month literally behind. Regardless, anyway, um, yeah,
Okay.
I'll confirm that for you, but I think you could be right actually, right? It could be for the month of September. And so when November ends, we're getting the data for October. Yeah, sounds about right. Sounds about right, actually. Yeah, it could be that way. So,
Because, because they're saying that it is being released monthly about 35 days after the month ends.
yeah, so it's the previous month.
Okay.
35 days after the month end.
Yeah,
So it means it is for
yeah,
September.
yeah. So this is
Oh,
month. This is data for September then. Yeah, my apology. Then that's definitely data for September, not October. I guess it'll be too much too soon for that data to be readily available, I guess. Yeah, September sounds about
Mm,
right. So we're getting the data for September to, yeah. So when end of October, end of November, we're getting October's data. Yeah. Yeah, makes sense, makes sense. Right. So these are jobs created for the
jobs
month of
created.
September,
Okay.
right? These are jobs created for the month of September. Now, employment cost, I think it's that is quite, how can I put it? I would say it's quite easy to understand. It's the cost, right? So we're talking wages and other benefits,
Oh,
costs to the employer, not
okay.
the employee, right?
Got you.
Yeah, employment cost index.
So
I think
cost to
what will
complete.
help explain this better is our train economics because they tend to put these things very nicely straightforward. Let's see. Yeah, I'm very happy with my PC's performance today. I must say it's been well behaved. I've got to fiddle around with it. That apparently my settings were wrong. Let's see. Employment. The audio is perfect. Employment cost index. Let us see. I don't want cotton cotta. This is what did we get? Month to month. Oh, it was cotton cotta. Okay, great. Let's see it. Cotton cotta. Compensation costs for civilian workers in the United States rose. Compensation costs for the for civilian workers in the United States rose by 0.9 in the second quarter of 2024, slowing from the one-year high growth of 1.2 in the previous quarter. In the previous quarter, and slightly below market expectations of 1% expansion. The slowdown was due to similar pace in the moderation of wages and salaries that companies
Mhm.
pay. There we go. So I guess I was right.
Okay.
While benefits
Yes.
eased, I did also mention those benefits. While benefits eased to a small extent, 1% versus 1.1. Compensation costs fell for both the private industry and state and local government organizations. On an annual basis, compensation costs rose by 4.5, right, in the second quarter. So, this, sorry, right? So I think this is Q1, this is Q2, where's Q3 then? Shouldn't we be, are we only just getting the Q2 numbers now, second quarter? Yeah, seems so. Yeah, okay, okay. It makes sense. So Geez, but that's quite a bit of a delay for getting the quarter-on-quarter numbers. So yeah, we just only got the Q2 numbers now. So quite a big decline, I must say, in employment costs. This is something that definitely the Fed would be happy about, right? Because it speaks to inflation, right? So how does that impact your dollar? Definitely negatively, right?
So, Mr. Lebo, so you're saying employment cost index, maybe you can um, summarize it in what is its meaning in a simplest form.
In the simplest form, employment cost index basically is all the cost to the employer, right? So salaries, wages, benefits, and what else? Compensations. I'm not too sure what this compensation cost is, right? But essentially, what I've always understood it is, it's basically it's the cost of the employer employing you, right? So it would be all the benefits and your wages, right? How much does it cost me to employ this particular individual, right? So of course, if employment costs go higher or rise, um, that is not necessarily a good thing in the long run because it spells higher inflation. Does that make sense?
Okay, so it means when it is high, it will increase the inflation.
That's correct.
Okay.
So we want this to be lower. And when you read your monetary policy statements, is something that once in a while they'll mention, right? That employment costs are quite high. They are concerned about it. It's adding pressure to inflation, right? So definitely seeing a downward revision, as you can see. Let's see if we can see how high it went in the past. I want to see. We can see that it started to definitely see 2020 picked up. Not too sure why it dropped, but then it has been gradually going up. And we all know from 2022, that's when the monetary policy changed. So it is now moving in the right direction, right? So basically, if you're to compare employment costs, your employment cost index, and you're to compare it with, let's say, your core PCE, which is coming out tomorrow, we should see the move in the same direction. United States core PCE price index and your change. Let's see that.
Also, in the simplest meaning, that personal consumption expenditure, it means how consumers spend. It shows how consumers spend. The personal.
I beg your pardon?
The explanation, also simple explanation for the PCE, personal consumption expenditure. Is it that the level of consumption
Yes,
by a certain consumer?
Yes, 100%. 100%. Right. So we can definitely see a positive correlation between your employment cost index and the consumption by consumers, basically, which is the data that we are getting tomorrow. Right. So your employment cost index is that blue line, and your PCE is the one in this gray. Is it gray? Yeah, it looks gray to me. Right. So they definitely have a positive correlation. So your employment cost index coming down would basically mean, or inflation would also likely follow suit, right? But do expect a latency or a bit of a delay in that correlation. It doesn't mean that the fact that your employment cost index goes down today, your inflation numbers will also go down today. No, it has to work itself. It has to work through the economy, right? So there will always be a slight delay in that data. Don't know if I'm making sense. Back to the calendar. Yeah, go ahead. Is there a question? All good? Okay. Where is, because this is Thursday. but I'm not seeing is the data, man.
So we can say also employment cost index, it also acts as an indicator for inflation, we can say.
Yes, it's important. It is definitely important. It does impact inflation. Anything to do with labor would definitely affect inflation, right? Anything to
Okay.
do with labor data or
Labor
labor
data.
would affect inflation. Remember, these previous readings that we've been going over by the Fed have always made mention of labor and inflation. The entire year 2019, labor, inflation, labor, inflation, labor. Those two are definitely married, right? There's definitely a strong correlation between labor and all its components. If we're talking employment costs, we're talking unemployment, we're talking unemployment claims, wages, all that affects labor, anything to do with labor, right?
It affects inflation.
It affects inflation indeed. So tomorrow we also get unemployment claims that comes out weekly. So there is previously 227. It might come out higher, they predict at 229, which then, of course, if it does come out higher, that is negative for the dollar, right? It is negative for the dollar. But that's, I've noticed that on the week of NFP, sure, it matters, but like I've always said, it comes out weekly, so it can be a bit noisy. If you remember, I've mentioned that. So how you want to maybe look at unemployment claims is look at them this way. These unemployment claims.
I think here it is initial jobless claims. So good.
Oh yes, I think last time I said jobless, no?
Jobless claim.
United States, yeah, I want to see the 4-week average. For me, that is a much better chart to look at, right? So the next one on this one is the 31st. For me, that would be it's much quieter. It makes much more sense. I'm able to use this data much more effectively in terms of formulating my bias compared to the weekly. The weekly, yeah, sure, it may move the market, but I find it to be a bit noisy. The data, it's highly volatile. Right, this week it's up, next week it's down. This week it's up, But overall, yes, I'm not saying you don't have to look at that data. It's important. It's tradable. What you want to do though is put things into context. What trend is it in? And as you can see right now, honestly, it is rather noisy. Previously, we did keep some sort of a downward trend, but in the last 3 weeks, it's been a little choppy, right? We broke out and then we started to cool off again. Will we cool off? Hard to say because this week they're saying 229, previously 227, right? But of course, anyway, if it does come out at 229, that is definitely negative for the dollar, right? That is definitely negative for the dollar. There's some data, man, that I'm not seeing regarding its ADP. Oh, okay.
Yeah.
I know what it is. Last month, if you remember, we went over, sure, JOLTS jobs opening, ADP, but we also had ISM, manufacturing and services data. You remember that?
Yeah.
So now, yeah, this is going to be quite a tricky one because now this ISM
It's on
manufacturing
Friday now.
Friday. And that on its own has got labor data. We want to understand, how the labor is, faring under the manufacturing. So there's a lot of moving parts this time around. The previous month, it came out before the NFP, right? Including services. Let's go to last month to refresh your mind. Yeah, your mind. Last month, let's see. Was the last week? Let's see. Yeah, this was the last. Let's see. Consumer. Okay. I've gone, I think, too far. Let's see. Oh, I think, all right. When was NFP? Okay, NFP was on the 4th. So this week here. So we have Tuesday, JOLTS as usual. As you can see, it picked up. So that's why we're playing those. We played the gold cells, if you remember, right? If you go to the 4th, rather, what you call this? Is it the 4th? Yeah. If you go to the 4th of October and you look at gold and compare the recordings that you'll see, we were looking for those cells of gold, which we definitely caught. Let's see. Tuesday. Where are you?
Yeah, but now.
Okay, now hold on. I beg your pardon?
Sorry.
Oh, okay. All right. Tuesday, JOLTS jobs opening. That was a push to the upside. Okay, so let's do this. I want to write them down. Where's my pen? JOLTS. That was up. Okay, I'll just put arrows, right? So that we know how it fared. So that was JOLTS. Then Tuesday we had ADP. Where's ADP? No, sorry. That would have been Wednesday, ADP.
Wednesday.
ADP. That too pushed higher. I'm just going to put an arrow here and say ADP. It was up. So already, right, even if you did not go into GBP USD cells and gold cells, especially GBP USD and Euro USD, if you were not on those cells, based on just the JOLTS, then definitely ADP would have confirmed that for you because the dollar would have been going up, right? So GBP USD, Euro USD would have been selling. So that second round of important data, ADP pushing to the upside, right? Now, then we have Thursday. Was that the only thing? There we go. I missed something important. There we go. What I was looking for. ISM manufacturing. There it is. So we had JOLTS jobs opening and we had ISM manufacturing. ISM manufacturing sharp. Let me just try and get it up here. ISM manufacturing 47.2 came out exactly unchanged at 47.2. The focus was 47.6. There was an expectation that that sector would expand a bit, but it came out unchanged. And that's the only reason why this number is in red. It did not meet the market expectation, right? But overall, stable. So I would view that technically as a positive, right? But I do remember going through this data. When we went through the manufacturing numbers, let's just quickly go there. I think there was a contraction, right? There was a contraction. If you chart. In time from now. Let's try again. Okay, we're nearly there. And if anything, I think that data did show that employment definitely was down. So here we go, September. Oh, let's start first with August. So employment in August was 46%, right? And then in September came out at 43.9. So definitely, and as you can see, contracting and contracting faster. Now, manufacturing has been taking a knock, but overall, fine, yes, the employment, had contracted. The index itself, yes, number one, it's below the global standard of 50, which would signal expansion. It has been below 50 for some time, which definitely tells you that, it's contracting. So manufacturing, that sector definitely has been taking a knock. But we played it, we were quite neutral with, well, personally for me, I was quite neutral in interpreting this data. I figured, okay, yes, employment is, contracting, but overall the index remained stable at 47.2. So I'll just take it as, neutral, right? So we had that. And where was the services one? Where was the services? It may have come out before ISM. Okay, let's go down. So we're done with ADP. And then we
Maybe
got
it's not there.
unemployment.
That one.
Yeah,
It's up there.
there we go. Right. So then we also got ISM services. Now, ISM services printed above 50, or rather remained above 50. This was quite a big jump in the services sector, right? So this was quite healthy. So I'm definitely going to put that there. And I'll include also the manufacturing sector. So I'll do it this way, right? I'll say, shucks, let me just close these pop-ups on my end. So I can write, there we go. Another one. Okay, done. Manufacturing. Manufacturing, let's keep it as neutral. Then we have services. Let me put ISM. ISM. Let me put more effort into it. ISM services. That came out good. Right. So now with this data here, definitely the majority, anyway, leading up to NFP, was it negative or positive for the dollar? This was definitely positive for the dollar. Right? This was definitely positive for the dollar. So we were definitely able to front run that move. GU is the biggest trade that made me bucks on the 4th of October, if I remember well. I think I shared it. I'm just going through the Telegram quickly here so that I make sure that I was talking to the right group. But I think definitely, yes, no, it was because Medi Noah did say front running the move. It was, yes. GBP USD, I did share it on Friday, the 4th NFP. Yeah. So I said the positive labor data. So what I had said is the positive labor data ahead of NFP proved our dollar bullish bias correct. So we were already in that GBP USD sell trade. So it just played out beautifully. You can go and check it out. Go all the way up to the 4th of October. So yes, we expect to do it yet again. Now, it may happen, it may not. It's perfectly fine. But I think this time around, it may be a little tricky because why? We don't have as many facts as the previous month. We're getting our ISM manufacturing data and likely the services, the ISM services data only after NFP. So that sucks, I must say. Let me try and get to this month. Where do I go? Okay. Let's rather look at this week. We're only getting that ISM manufacturing on the same day, 1.5 hours, I think, after NFP. That's not services only in the new week. right? So it's not quite how I would like to engage it, but we're gonna try it nevertheless. We'll work with
Like
with
up
those
to now,
two. Hopefully, we
maybe up
can.
to now, how do you see it?
Pardon?
Yeah, maybe let's start from now. Maybe what of to see the bias as how you are doing before. Maybe
Yes.
for the job now it has been down, jolts.
JOLTS,
Mm.
JOLTS are to the downside. There's definitely a contraction on JOLTS, pushing the dollar index down. Gold, as you can see, is pushed up. GBP USD to the upside, Euro USD to the upside. So that's just today's data. The
So
first round, you might want to wait for it maybe to just come a little deeper. There it is. So you've got your trade opportunities for GBP USD, just simply based on today's data and based on tomorrow's anticipated data of yet ADP. Okay, so if you look at your ADP data Wednesday, where is it now? I'm looking at the wrong thing here.
that is September.
This week, it's right now. Let me just
So
get.
we should not consider the consumer confidence, the consumer which came positive.
Yeah, like I said, the only thing for me, or rather, the most, I think if there's any data that's going to take center stage is the labor data this week,
Mhm.
right?
Yeah.
That is the most important data that will overshadow pretty much everything else. And honestly, consumer confidence for me isn't the biggest data, right?
Okay.
It's almost like a gauge on your psychology or your, how can I put it, on your, it's just I guess, an opinion, right? Of how, I mean, if I guess they ask you how confident are you about the economy, it's quite an emotional
Yeah,
question, it's not, I want hard facts. So it's according to Forex Factory, it's high impact data, but honestly, comparing it with JOLTS, jobs opening, I think that's hard data. That is
yeah.
serious data compared to a survey on consumer confidence, because confidence isn't it an emotive word?
Yeah,
Yeah,
it is.
because just like an opinion, how do you see?
Exactly, right? So hence I said, it doesn't give me confidence.
But because as you can, if you want to make sense here, as you can see the job opening, it is true that it has decreased, which is true. So it means it is big.
It's
It is a
big
big news.
data.
Yeah,
It is big data because honestly, if consumer confidence data was that big, the dollar index wouldn't have come down. So what the market was reacting to, which they found important, is definitely that labor data, JOLTS, jobs opening today, right?
Okay.
Because we definitely have seen a push to the downside on your dollar, push to the upside on gold, GU, EU. Those are definitely up. So that's quite clear what they were reacting on, right? So like I say,
it
those
means
trade.
now.
Mhm.
So it means now I've already understand when you get a lot of news, we need to check also for those most important news to see how we're going to react. If maybe in a
Yes.
certain week you get a lot of high impact news, but there are those very
Well,
important news, maybe we should
yes.
consider them.
It's that animal farm situation. All the animals are equals, but others are more equal than others, right?
Yeah.
So yes, it's important,
So
but it's all about context. It's all about the theme at that time, right? Because currently, right now, the theme has been labor and inflation. It's still very much relevant. Um, and so if there's any data paired up with, the labor data will take center stage because we know and understand how it affects inflation. But now it's not always going to be the case, right? There's going to be a time in the global economy uh, where it's neutral, where the data isn't really that important anymore, where things are almost back to normalcy. And then another theme will develop. Don't know what it is, but another theme will develop. Something will be important to traders and investors, right? We don't know what it is yet, but yeah. It will.
So, Lebo, so would you not then say it's better that we see what the labor information tomorrow looks like before we can formulate a bias?
Yes, you can, right? You can wait for that ADP non-farm employment change to come out. The prediction is that there's going to be a contraction from 143, right?
Yeah.
To 110. Now, what I was saying earlier was that just based on the JOLTS jobs opening data, that and looking at the technicals was perfect, right? GU already from yesterday gave you, it bounced off a key level of support. It's just recently, violated a key level of resistance. This would be a Fed data, right? Especially if you believe, right, that, yeah, I think definitely this ADP non-farm payroll may likely actually show a contraction, just as the economists predict. So you've got it, right? Now, this is your entry. Now, if indeed that data comes out as predicted by economists, entry, you are already in it.
Okay.
Let's look
But
for
Mr. Lebo, when you maybe you look to the daily time frame
this
of
is the type of trade.
USD.
Yeah, I'm on the hourly. That line is
I'm saying when you
Try
look
again?
to the in the resistance the area in when you look to the bigger picture in daily time frame, the GBP/USD.
Oh, look at the daily picture.
Yeah.
All right, on the daily, what are you seeing?
And we may be in a certain resistance there. If you try to look.
We still have some room, I think. Let's mark out also this candle. Yeah, we've tested on the day, definitely some sort of level of resistance. I wouldn't definitely 100%. We definitely have really bounced off a key level there. Yeah. Thank you for that. Okay. Right. So, how do you want to play it? Do you want to wait? Your intraday time frame, you've got the opportunity. It's entirely up to you. This will, your trade will be determined by your risk appetite, I guess, to a certain extent, right? Perhaps, maybe, because this is the daily line. Maybe if we just close, right? So only, in other words, let me just illustrate it. Maybe you want to see that. That will be safer. Perfectly fine, and I understand that, right? Or simply sit on your hands and let's see how it plays out tomorrow based on that ADP data. If indeed it comes out as a today's resistance, which is that one, was it 1.3010, right? Which is this one here, 1.3010. Highly likely that then it will be broken. Right? Does that make sense?
Yeah, it makes sense. Maybe if you want maybe to fund on there, I can see in EURUSD it is on the support. Maybe it's gonna be confident a little bit to
EURUSD.
Let's check EURUSD.
Let's see.
And the daily, see how it is.
Right. I don't know if my trades make sense. I don't remember when I did this. When did I do this? I don't know if it makes sense, but descending channel resistance. Today's the 29th. Oh, the sharks, we bounced off. What time was this? Oh, and then based on the US jobs opening, then we rebounded out of this. Not very similarly to GU, but I would say, of course, a close above this price point, as you can see previously, resistance. We saw a lot of market close above. We'll give you a push. We may see something like this. Let me extend this quickly. So it might do this, right? So some won't be too comfortable entering at this point. They would want to see definitely a break of that bearish structure. Those previous highs for today, if we violate, then they would feel comfortable entering, right? So yeah, this may be a little bit premature or aggressive to others. Some may want a bit of a late entry, which would make them feel much more confident that indeed bulls are in charge. I think if there's anything that we can agree on is those bulls are definitely in line should our labor data contract, right? If the labor data contracts, then we definitely are not changing that bias, right? So let us contracts, you will definitely see a violation of the structure, USD, including your GU. Those buys are in order. Right? So nothing wrong. You don't have to enter now. You can sit on your hands, wait, see the data. And when the data comes out, you don't have to quickly rush to the chart and try and enter. You can wait at least 30 minutes, 1 hour, and actually really understand the price action that you're looking at. You would have already, prior to the data coming out, you would have identified levels of interest on your chart, and you would have a criteria for yourself to say, if the data comes out positive, for me to enter, I want to see X, Y, and Z happen. If I'm satisfied that that has happened, only then do I have a high probability setup. Only then do I have an opportunity to enter into that buy trade, Euro USD or GU or gold as well. So you mustn't chop and change or be wishy-washy about that. You must always follow your criteria religiously. Don't chop and change. Always have a criteria for yourself. You don't want to enter into trades based on impulse. And for the sake of, oh, the market is moving today, we've got ADP. Let me just quickly go in. That's how you lose money. Right?
Yeah.
You would have thought about it. Okay. Righty. So that's basically our labor data for this week. But like I said, NFP might be a little tricky. But if anything, I want to see what the prediction is for this NFP. 0.4 was previous, 0.3, they're expecting a contraction. NFP previous 240, 254, they're expecting a contraction, and unemployment rates to stay unchanged the same. So it seems economists are basically expecting now the labor market to cool further this month. The previous 2 months, it was pushing up. Now they're expecting it to cool further, right? Now we don't know what informs their calculations and these predictions. I don't know, right? I don't know what goes into that. But that's what they're expecting. If indeed, if you look at broadly speaking, the economic indicators out of the US have been fairly good, I must say, for the month. But they are expecting to see a contraction in the labor. But like I said, the bigger picture when it comes to the labor force, anyway, has been going downwards. But anyway, there are times in the year where it would, pick up a bit. So these are the last 2 months, and now they're expecting this. So let's see if that's the case. So just already based on those predictions, it's telling us that the dollar index is likely going to do this, right? JOLTS jobs opening has already proved that it's contracted, right? ADP, if that also comes out tomorrow, the dollar definitely will continue in that direction, downwardly. As an easy.
I have a question.
Yes. Please go ahead.
A quick one. Have you seen a correlation between the JOLTS and the ADP data? Like, do you think they usually move? Do they have like a partnership? No. Do they usually move in the?
Okay. Let's check.
Because last month it looked like
if I remember,
it was same. And now when I look at the description of ADP and the one affects the other,
yes,
almost same, but different name.
Yes, this would be positively correlated. They move in tandem. United States employment change. Then let's bring in JOLTS. I want to compare. So what I do is just do that and click JOLTS. Where is our JOLTS? We might actually just find JOLTS here. JOLTS jobs opening. There we go. Hey. Okay, let me start with JOLTS jobs opening because it's easy to find. Right. So I'll say and then compare it with ADP. ADP non-farm. United States ADP employment change. Okay.
Yeah.
Right. I think it's best that we brought it out. There we go. So yes, they are definitely positively correlated, especially if you look at 2020, where what's in gray? ADP, big decline in ADP, followed by also your jobs opening. Right, so we can see they don't. It's not to the same degree, but definitely in a very similar fashion.
Okay.
Mhm. That's a fantastic question. That's what we call ratio analysis, by the way. Ratio analysis. Some will call it intermarket analysis. They're slowly becoming proper,
Kancane
should I
kancane
say, commerce.
siyazama.
So no, well done. So yeah, I think we've spoken about labor at length. And yeah, guys, don't be too hard on yourself. You know, it's a lot to take in. Enjoy the learning process, take your time. A lot of people will lie to you and say you're gonna be wealthy next month. You know, come do my course, blah blah. No, you're up against extremely smart people. Like I always say, on average 2 degrees. Those who know, Dumisho, who does sometimes the fundamentals. You know, those are the type of young guys that we've sponsored their education. They're extremely smart, extremely smart. They may not have the type of work ethic that we want yet, but we are grooming them. But they are extremely smart. Demisha's got 2 degrees. We've got another one behind the scenes, Tabo Manzi. He's an actuary. He's what else? We've got mathematicians, Strauss. So these are the type of people that you're up against, right? So do not believe this thing that or those who want to make it out as if trading is extremely easy. No, it's going to be easier if you give yourself time and be patient with yourself to understand what I'm talking about. Go through the recordings. Feel free to contact me during the day, whatever. Ask your questions, send me a voice note. Whatever you don't understand, you will eventually understand it, right? And this is where it becomes fun, right? Because you are doing things with understanding. And that's why I don't mind going over something many a times. For some, it may be boring because they want to get it done and over with. They seem to understand, right?
I
But
have a last question.
yeah,
At some point before the 4th, can we explain liquidity and imbalances in layman's term?
no problem. And I don't think we'll be done by
Like,
the 4th, right? I don't think we'll be done by the
because
4th.
I think it's affecting when I do my own trades. I feel like there's a little piece that I've not grasped, and I think it has something to do with that,
Okay, no.
especially with candles that have that spike, that long
Okay. No,
thing out of the body.
okay. Yeah, where you get extremely long candlesticks, your marabuzos, they would call them,
Yes.
right? And some then,
And then
mhm.
I've been trying to understand imbalances on my own, but I'm not getting it at all.
Yeah, for me, an imbalance, honestly, I try and keep it very simple. Like I said, there are many, methods in terms of technical analysis, such as, your SMCs, and, they really go deep into it. But it almost becomes like a wine tasting event when it comes to trading, or rather when it comes to technical analysis. I think sometimes we just get into a frenzy. It becomes it's very abstract. Yeah,
Mm.
like I said,
I also got that sense because when you start doing the research, people are saying too many things, and then I was just like, oh my hat. Let me
yes,
just ask one person to simplify it, tell me what matters, and that's what I'll focus on until I can form my own opinion.
100%, right? And it doesn't mean that I'm always going to be right. Now everybody's just fighting to be right, and they think that their way is the only way. No, there's multiple ways of approaching the market. But for me personally, for somebody who discovered, trading back in 2007, um, I've tried a lot of things and I've done full circle, what is it, 360 degrees, right? And I
Mhm.
I can definitely say that simplicity will always be the best method of approach. I've tried them Wyckoff and Wyckoff, or some will say Wyckoff. Basically, SMC is inspired or was inspired by Wyckoff. Is one of the best technical chartists out there, of the 21st century, or was it whatever century it was. So there are many, 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 many ways to go about it, right? But how I would explain an imbalance in the market is simply what we've been doing, right? It's if we have this level, and price has been testing it and not breaking it, and eventually it breaks and it goes all the way up. There's an imbalance in the market.
Mhm.
Simply put, there's an imbalance in the market. We have violated it, we haven't come back, right? There's an imbalance in the market, there's a lot of pending orders. Many traders have got those pending orders. Some will call this then a liquidity region, some call it a liquidity,
Oh, no.
right? So that is a imbalance for me in the market, and I expect price to come and address it, right? So
Okay.
yeah, that's how I would describe a imbalance in the market. We have had a significant push to the upside without testing levels of interest.
Got it.
Which is what gold is doing now.
Exactly.
Yeah, sure.
Right. So I'm going to some maybe who are deep in this analysis thing, technical analysis, and they've been doing it for maybe 3, 4, 5 years, they might look at my analysis and say, why is it too simple? Because they've really done a Picasso with theirs, right? And mine is not a Picasso. Mine is this. Let me show you. Is that thing, right? So mine is the stick man. My art is the stick man. It's not confusing. There's you can see the hair. You can see that tweezers were used on these eyebrows. It gets
Wow.
yeah, it's I think I'm even oversimplifying there as it's an abstract painting, right? And abstract paintings because I go to these art galleries and what you see there, you see people and I just laugh in the background. And you're seeing splashes of paint and somebody says, "Oh wow, this is so beautiful. I can see the ocean. I can see this. I can see that." It's like a wine tasting.
Mm.
It's the same. They'll ask you, "So what do you taste?" And someone will say, "Rain." And this, I'm like, "Rain? Okay. Why can't I taste it?"
That's where I found myself. I was in a wine tasting and I was not a connoisseur. And I was just like, there's too many opinions.
You're right.
People
But
telling me about Cab Sav and Merlot, and I'm like, I
yeah,
just want red wine.
hey, and I'm like, I can appreciate a good one. I'll tell you, this is good, but hey, let's not take it too far with this. What am I
Yeah.
tasting thing in it? I think that's where we talk each other into a frenzy. So technical analysis can get out of hand to that extent, right? So I want us to keep it as simple as possible. Our paintings must be that simple, literally, because it's an art, right? The art of trading, if you remember the first book that Rev authored. The
I,
art
th-
of trading.
yeah, I think for me, your simplicity has helped me a lot.
Hmm.
I think I'm just a little bit unsettled now with the gold because of there's no background to match the song going forward. What's actually where is it going? So
Mm.
I've told myself that the easiest way to deal with gold
No, I'll tell
is
you
to
what.
wait for it to return.
No, the only thing that unsettles you with gold is that, and I said it last week, I think, and it's doing this to so many traders, and it did it also last year in the last quarter. But this year, specifically, just look at the weekly chart. I mean, how would you have caught this? It's not giving you any chance. right? This is the entire year. This is a parabolic move.
Yeah.
It's absolutely bizarre. We are not seeing it. I mean, if you go to a weekly chart of any other chart, any other thing,
Yeah.
it goes
Yeah.
up, but gold is just up, up. It's one big, so this is where the traders are like, okay, I want it to go down. I think it should go down this week. Okay, I'm gonna sell us, yeah, that's where it's extremely difficult. But if there's anything you should know and understand very well, is that gold is going up. And there is no fundamental catalyst for it to go down.
Yeah. You should just find a point of entry when it retraces.
Your point of entry to
a little bit.
Right?
Yeah.
If I, find your point of entry to buy. We said earlier, we want to come down here ideally and then we'll buy. If it doesn't, I've already marked out 20. So it's not playing fair. Let's put it. So what do? You have to go to the 15. Let's see. Either you're going to this blue, right? And enter at this point and say, okay, I'm gonna put my 10 pips, maybe $10. If you're going in at 27.73, maybe 27.63, that's $10 difference there. That's where I want to be stopped out back in, right? But fair value, honestly, this is where it is, right? In the immediate term, this is where fair value is. Yesterday I mentioned 26.96, and I said before that, there's another level as well, which we haven't gotten to retest. Can't even remember what 26. Yeah, right. So we just have to adapt. Hey, I don't want to lose. What if I'm going in and then it does come down? Well, your stop loss is there for that, right? You can't prevent losses, but what you can manage is that loss, how much you lose. Losses are going to be there, right? You know exactly where you want to catch that trade. This is fair value. If it doesn't and it continues to push higher, don't rush it. It's the first candlestick. 50 minutes is still early. Get it, let it do its thing. It might come back down. Boom, boom, boom. 27.70. Then you buy. Because what's sure. It pushes a little higher. 27.80 maybe, and then comes down. Sure. It might not even go down to 27. What's that? 27.70. Right. So what we do is we're gonna mark it up like this. We need to accommodate these candlesticks. So this, and fine, if we buy, we expect this to happen. But if it doesn't, then we need to know how much loss are we willing to take. Maybe that's where I'm willing to take my loss. If I get stopped out, it's perfectly fine. I have to wait. It might play around here, play around. If it comes here, yeah, that's fair value for me. I'm going to buy. I know why I'm buying. It's been playing there. Here's your imbalance, Asania, right? Market imbalance. There it is. Dum, dum, dum. Expected. So maybe it's just playing here. Maybe it's gonna come here, address that imbalance, push higher.
Okay.
So I'm definitely, of course, like I said, if I'm going to catch buys above here, I want to see that, right? This is the resistance, must come back in, we'll buy. But if I buy and then, hey, actually it's decided this was only just a liquidity grab or a fake out sample call, and it's actually coming down here, I would have been stopped out. I'm not going to hold on to this trade. It doesn't mean when I close the trade, I no longer believe in the buys. It's just simply a trade that I'm not that I cannot afford to hold on to. The loss will be just too great. So I'll close it and then I'll wait for another opportunity here. Simple as that. That's our gold, right?
Fascinating.
Okay. Thank you.
So, Mr. Lebo,
Yes,
so it means according to you in a technical picture, you just maybe is there anything that you add on before you enter, or maybe you use that pivot what you're talking, which you told us you're going to teach us later?
No, I don't want you. It should not even be in your head at all. You see, I don't mention it for a reason. Even if you didn't even get it right, like it wouldn't even because not a lot of traders have it, and they're exceptionally good. I've got a lot of traders who don't see the benefit of it, and honestly, that's just a confirmation tool, right? It doesn't inform my trade decision. It's or my bias rather. It's just a confirmation tool. It helps us with targets to know exactly for the week, or rather for the day, for the week, for the month, and even for the year, where bulls are, where bears, are. But in terms of my technical analysis, I always follow the TLS, um, which is your trend, level, and signal, right? So that's what I want to do. TLS, it was coined by an old friend of mine back in Australia. We started at the same time. We started training at the same time, but he was much better at it compared to me, because I guess he had access to information. And so we used to, interact. I guess that's how it was, you would interact with strangers that you didn't know what is that thing before Zoom and all of those things? Um, Skype.
MySpace.
Okay.
Oh,
Yeah, so I would be talking to these people, and I found him to. We just clicked. So he with this. I mean, I haven't spoken to this guy in years, but he, over the years, as we myself as well improved over the years, he also had his own online coaching institute and blah blah. And yeah, so the TLS is something that he coined, and which it made a lot of sense, because I never had a term for it, but this is something that we are always talking about. So it's the trend, it's the level, it's the signal. So you want to establish, where's my pen? You want to establish the structure, right? It's your trend. You want to establish those levels, and you want to, find that entry signal, be it in terms of technical, be it a candlestick with rejection at a key level of interest, right? Let's say we were looking at this particular bearish structure. We've got key levels of interest, and the market has been moving like this, right? And it's at a key level of resistance and a horizontal level, which has been respected back in time, right? And what we see at this point, maybe it's a candlestick with rejection, showing that there's definitely market exhaustion. But the most significant, or yeah, I would say the most reliable and significant signals would come from your 4-hour time frame and 1 hour. Anything below that, it might be a false alarm. So if you see a candlestick wick rejection at that point, that gives us confidence that, yeah, no, indeed, we should be selling, and we push, or we expect price to push even further below. So that's your TLS. You've got your trend, you've got your levels, and you've got your signal, TLS. So these are the things that I've been doing day in, day out, the same way. It's boring, but that's how it is. And nobody said, making money is exciting. Making it is exciting, or having it finally, yes, it's just a byproduct. But you have to put in the work. So that work, doing the same thing day in, day out, it can run you a bit crazy. And so sometimes I simply take 2 weeks, sometimes even a month, where I'm not trading at all, right? I'm not looking at charts. It's just healthy for you. So those are the things that I would look at, and then I would incorporate 1 or 2 indicators. But the one that I always use is I'll have my 20, my 50, my 100, and my 2. Hey, what did I do? 1,000, 100 and 200. We're talking EMAs, and I think we've covered these, exponential moving averages, right? This is for short term. This is medium term. This is, I would say, best for intraday, which is also medium term. And then this is long term. So, of course, if you go back to those recordings, you'll see the significance of these. So I would, also incorporate my EMAs, right? Of course, let's say, for example, if this is the 200 EMA and the candlesticks have been moving towards it like this, I'm not just simply going to buy this instrument while price is at the 2. This is a significant level of resistance. It is what we call dynamic resistance or dynamic support, right? Because it is invisible to the eye until you use it and actually put it on your chart. Maybe you've identified a level there and you've seen how prices behaved at that point, and you wonder why, when you bought here trying to close there, why did price all of a sudden go down? There was no level here. It's your dynamic level of resistance in this instance. It is invisible until you actually apply it and put it in that EMA, right? That moving average. So those are the things that I use for my technical analysis, right? Perfect. Okay, it's almost 9 o'clock South African time. Oh, by the way, guys, we've got a question mark on our Thursday session, but I will confirm. Hopefully, I won't have to be on the road on Thursday. One thing I think that I should talk about today, which is real quick, is GDP quarter on quarter and earnings, right? Because time is not on our side. But when it comes to, let's start with the earnings, because earnings should be out actually. Remember, I did say on the first month of a new quarter, we get earnings season. So we're getting reports on how these companies performed in the previous quarter. So today we've got the big boys coming out. They were scheduled to come out just after the market, the closing bell, US, with which I think it could be in the next few minutes. I think it could be in the next few minutes. I'm not too sure when is that, 9 o'clock South African time or 10. But we've got Alphabet. This is Google, right? This is a big boy. And we also have, okay, Visa's a big one, but if I remember well, man, Microsoft was supposed to be here today as well. Microsoft, am I wrong? Okay, I could be wrong. But definitely the big boy there for the day is, it's definitely, no, and Meta, man. Why am I not seeing these things? If I remember well, on Bloomberg, I had Meta, which is basically Facebook, Microsoft, and it's Tuesday. Okay, it's Monday, Tuesday. And Google. I was expecting Meta, Microsoft, and Google. These are the big boys, right? But nevertheless, I'm seeing Visa and my Alphabet. These are the ones that I'm familiar with. And let's see how that's going to play. As the previous number was 1.55. We don't have. Okay, there's an expectation that 1.85, but that's, yeah, 1.84 rather, sorry. Right, so let's see if there will be an improvement in these stocks. Of course, these are the heavyweights. Now, like I've always explained it, Nasdaq, or rather Alphabet, which is Google, is a tech company, and Nasdaq is tech heavy. It's got a lot of, that index is made up by a lot of technology companies. So, and Alphabet being the big boy there as well. So I'll show you what I mean. Let's go here. Let's go to home. Let's go to home. And then I want us to look at the screener. I think it's called the screener, or a heat map. No, a heat map actually. So I want us to look at the heat map so you can get an idea of how big Google is, or Alphabet as they call it. So you go to products. That's still products. You go to screener. Then we want heat maps. Heat maps, stocks. That here, right? And this is Apple, this is Nvidia, there's your Microsoft, there's Google. So Of course, as you can see, these boxes are, right? Can I get it this time? Okay, I can't. Let me just move this. Meta, that's Facebook. Amazon, quite sizable. Tesla, Visa. I think Visa's coming out today, if I saw right. Right. So as you can see, it's rather mixed on the day. Okay. Yes, the big boys relatively performing well. But overall, all the other ones quite small. So let's say if what you call this, if Google performs badly, of course, in the next couple of, let's say within the hour, it definitely might affect the Nasdaq index to the downside, because then everybody else starts to think, oh, maybe all these technology companies may have not performed as well as we would have thought for what you call this, for Q3, right? So that's something that you want to be aware of. Whenever the big boys have their earnings coming up, it will definitely affect the entire index. Because think about it this way, if you want to understand it better, if we have a very heavy object to pick up, and we have three very tough guys and one skinny guy who doesn't quite have the strength. They're all picking up. It's they can pick it up. It's quite easy. But once one of those three tough guys steps away, you start to feel the weight, right? And if another one steps away, you're definitely going to feel the weight as a skinny guy, right? So
Sorry,
that's
may I repeat that?
the
If one,
index.
if one picks away from there, I'd not get.
Right? You've got four guys picking up a heavy object, right? Four guys. Now the three are tough guys, and one is just an ordinary guy, just a skinny guy, no muscle. But they can pick up, this heavy object, all four of them, right? The weight is evenly distributed. Let's put it that way. But once one of those three tough guys steps away, you're definitely going to feel the difference. The weight becomes heavier, right? And if another one also steps away, you're definitely going to feel the weight. So it's tech heavy, and these are big companies. So when the big boys don't perform well, it affects all the small ones, right? But if a company like here, this small one here, if it does bad, don't even know it. Never seen this one, don't know it. Even if it does terribly bad, like 20% loss, it's not going to affect the index. Let me
Okay.
put it that way. You follow?
Yeah.
Okay. Right. So that's what we're expecting. Let's see how the market will react to that, to the earnings. But if I remember what I saw, 8 much fireworks on Nasdaq. But there's a possibility that if, of course, the data or the earnings come out very well, perfect, and it aligns with the historical tendency that we've observed over the years, that the last quarter tends to be bullish anyway. Now, remember, if you look at October, I think we did it already. If you look at Nasdaq, Dow Jones, S&P for the month of October, it has been, right? I did a review on that. October has been bullish for Nasdaq, Dow Jones, and S&P 500. So let's move on to the last item before we close off, which is GDP, and then the rest we'll do tomorrow. So GDP, quarter on
Mr.
quarter.
Lebo, just a small question there to those numbers as we see it is what, like, when we're looking the screen as there, like for Google, Nvidia, those plus 0.95 or plus 1.2. What are those?
Those are that's how it has performed on the day. The ones that you were seeing on the blocks, in the boxes. Yeah, so that's the performance on the day. Up 1.5%, other one up 1.8%, other one up, 0.25%. That's just the performance.
Those are what, up in terms of share, in terms of capital, or in terms of what?
I beg your pardon? That is the
That 1 point, like plus 1.25, is it?
That is the performance on the day. The price has moved. The share price has moved by 1.5%. That's the share, right?
Okay.
You follow?
Yeah.
Okay. GDP. So when was GDP? Tomorrow, ne?
Yeah.
Cotton.
Yeah.
GDP. Okay. So now GDP, let me go to it. Advanced. So it's red, right? And which means it's high impact data. But the Fed was a little naughty back in 2022, 2023, and actually back in 2020, because they wanted to confuse me a bit, right? And I just couldn't understand what they was trying to say, because now GDP data is important. It's a measure of how, of production, gross domestic product, or some will say productivity. That's how you measure. That's how you measure how an economy is growing or not. Simply put, holistically, that's how you would measure the broad economy. GDP, yes, that data is lagging, be it month on month or quarter on quarter, because if you just type in and start doing research on what are the components of GDP, then you see that, oh, these indicators, these components of GDP, actually, this is macroeconomic data that I always engage that comes out, So this data, which makes up, which are the components of GDP, you are able to preempt how then GDP, the final GDP number is going to look like, right? So now the Fed, will always make projections on GDP, etc. But when it comes to, how can I put it? When they're asked difficult questions and reference is made to GDP, then they want to make as if GDP is not that important, right? As a measure of economic growth or / recession. So I want you to know that GDP is important, even though the Fed from time to time might not want to admit the significance of GDP, because if you go to their homepage, actually, because the theory on GDP is that GDP month on month, it's okay, right? But the quarter on quarter can tell you a lot about what is going on in an economy, quarter on quarter, right? So the definition, the real definition of what a recession is, or how you can define it with hard facts, is GDP. And a recession basically is when you have two consecutive months, or quarters rather, not months, two consecutive quarters which are in contraction. You follow?
Yeah.
Two
Okay.
consecutive.
So 2 months that are negative
Not months,
Quarters.
but quarters. So
quarters.
let's say
Okay.
January, February, March, Q1. That's
Okay.
quarter, right? And then April, May, June, second quarter. If we have these 2 months, we have Q1 contracting, and then we get the data for Q2 also in contraction, we are in what we call a technical recession. It may not be maybe as obvious or as or as harsh as what we understand a recession to be, but the fact of the matter is that economy would be in recession. Germany right now, as we speak, is in recession. Right? But now, the Fed has said, no, that is not how we define a recession. I remember this like it was yesterday because I was like, what do you mean that we are not in a recession? Right? I mean, look at this. Go to, where's the website? Okay, let's go to the homepage because I see the homepage. I saw this only today. So they'll have their inflation number. So they have I guess the most important indicators now on the homepage. So you've got the interest rate, you've got the inflation, PCE, the most preferred measure of inflation, which is also coming out, I think, this week. And we've got unemployment rate, and we've got gross domestic product, GDP. Why this? Why not something else? It's important. Why do they have it here if they say it's not important? Now, if you look closely here, this is 2020, right? Look, Q1 of 2020, negative 5.5% on GDP. The following quarter, negative 28%. 2 consecutive months in contraction. You know very well what happened in the first half of 2020. It's not rocket science. It's not difficult to find. It is in our face. Go to any chart, you will see that decline. Let's look at Nasdaq. Right? So Nasdaq, let's say weekly chart maybe. Right? There it is there. You can see how the market dips. We've made reference to this. You can go to crude oil, see how crude oil prices collapsed, going all the way to basically zero back in 2020. So, and when you actually come to their website, when you go deeper as well, which we'll do tomorrow, when we read their statements for March, right? We're going to start January, and then January goes to March. You will see how many unscheduled meetings they had for March 2020. They were in panic. Yet when reference is made to GDP quarter-on-quarter as a signal or as confirmation that the economy is in recession, they say, no, that's not quite how they look at it. But I want you to know that definitely 2 consecutive months of contracting GDP, the country is in recession. So GDP, or rather GDP quarter-on-quarter, is to be taken seriously. It's data that we look at very closely. So there will definitely be market reaction to that data tomorrow. Any question in closing?
No, not from me.
Oh, good.
That's good.
So you're saying it's gonna be 3%.
3% is the expectation. In other words, staying the same as the previous month, which is relatively good if you think about how the monetary policy has been so restrictive, yet the US economy has pretty much been resilient right through, right? Now, if that number dips, if it moves from 3 and lower, that might actually be enough for the Fed to say, you know what, maybe we should actually lower interest rates much more aggressively, right? This the economy. If like it's a shocking number, I mean, if it's 2.9, it's still good growth. Yes, it's a contraction. The market might react to it, sell, but it wouldn't be like it's not a significant divergence. But 3 to 2.5, maybe the economy is really slowing down. Maybe then definitely we shouldn't cut by 25 basis points. Maybe we should consider 50 basis points as we previously did, right? And so definitely that's where you're going to see dollar weakness come back into play, right? Let's leave it here for today, guys. Time is not on our side. Let's meet tomorrow. Usual time. If there's a change in the time, I'll definitely keep you updated on that one. Share this. Share that. Thank you.
Thank you.
Yeah.
Thank you. Thank
Thank you.
you.
Thank you.
Sharp,